Today we're going to look at closing journal entries. This is the back end of this accounting cycle. We've already prepared our financial statements, and now it's time to close out what we call temporary or nominal accounts. And those accounts are revenues, expenses, and dividends. Now I've put on the board what I call a mnemonic. Step aside here, and we see red ale. Red, I call these the red accounts, and I put them in red. Revenue, expense, and dividends. These are the temporary or nominal accounts. These get closed out. Closed out means set back to zero. And then we have assets, liabilities, and equity, our balance sheet. These are permanent accounts, sometimes called real accounts. These do not get closed out. So we're only going to close out the temporary accounts, the red accounts. We have 4 closing journal entries. First, we're going to close revenues to the income summary. Okay, the income summary, here's the T account for the income summary. The only time we see an income summary is in the closing process at the end of the period. And this is where we transfer revenues and expenses very temporarily so that we can close out the accounts, and then we're going to close out the income summary and transfer that balance, which is net income or net loss, into retained earnings, its final resting place. So the first closing journal entry is to close out our revenue accounts, and we have 2 revenue accounts. We have fees earned or service revenue. This is the service we provide to our customers. This is our primary source of income. And we also earn some interest revenue. So revenue accounts have a normal credit balance. So to close out a revenue account, I'm simply going to debit it. So by debiting fees earned, it now has a zero balance. Same thing with interest revenue. So I debit fees earned or service revenue for $75,000. I debit interest revenue for $9,000, and I'm going to credit the income summary for $84,000. In parentheses, I'm just going to show that that represents revenue. Okay? So here's my credit to the income summary, $84,000. That's my first closing journal entry. Remember, the only time you ever see the income summary is in the closing process. Don't think of it as an account that goes on the income statement or the balance sheet or retained earnings. We only see it in the closing process. That's to help us close out the revenue and expense accounts. Our second journal entry is to close expense accounts to the income summary. Close out the expense accounts to the income summary. Now expenses, we have 3 of them here: wage expense, rent expense, and utility expense. Expenses have a normal debit balance, so to close out an expense account, we simply credit it. Okay, so we credit wage expense, rent expense, and utility expense, and we're going to debit the income summary. Okay, 4858, 61,000, and I'll just put in parentheses, and you don't have to put this in parentheses. I'm just doing that to show you that the credits in the income summary are revenues, the expenses in the income summary represent the debit represents the expenses. Okay, so I'm going to debit the income summary for $61,000. Okay, and the way I like to describe it is, think of it this way: I took the credit out of the revenue accounts and I put them over here on the credit side, and I took the debits out of the expense accounts and I put them here on the debit side. Now, I have revenues of $84,000. I have expenses of $61,000. Remember, in T accounts, whichever side has a higher balance will get the remaining balance. This represents $23,000 and I'm putting parentheses, NI for net income. We had 23,000 of net income. Okay, and that's our third closing entry, is to close out the income summary to retained earnings. Okay, so the income summary doesn't really see a whole lot of activity. Just close out the revenue and expenses, summarize net income, and we're going to transfer it now into retained earnings. Okay, and the way I do that is I'm going to debit the income summary. That's going to close out this account. And I'm going to credit retained earnings. Okay, here's the journal entry. Debit the income summary, 23,000. Credit retained earnings, 23,000. Now, very important. If we have net income, as we do here, revenues are more than expenses, that's going to leave a credit balance in the income summary. So to close out the income summary, I would debit it and credit retained earnings. Net income is going to increase retained earnings. If, however, if my expenses were more than my revenue, suppose this were 90,000 instead of 61, that would leave a $6,000 debit balance. That would represent a net loss. And then I would, to close out the income summary, if I have a net loss of 6,000, I would have to credit the income summary, and I'd put a debit in retained earnings for net loss, and a net loss would reduce retained earnings. So watch out for the third closing entry, because it depends on whether or not we have net income or net loss as to how we close out the income summary. Okay? And then the fourth closing entry, and that's if we paid a dividend, we'd have the fourth closing entry. If you didn't pay any dividends, no fourth closing entry. In this case, we paid a $2,500 dividend. So I'm going to close out the dividend account, again, to retained earnings. Dividends have a normal debit balance, so to close them out, I'm simply going to credit the dividends, and I'm going to debit retained earnings. I'm going to squeeze this in here. I'm going to put dividends in parentheses. Okay, and that's going to tell me what my ending retained earnings is. So let's record the journal entry. Debit retained earnings for $2,500 and credit the dividend account for $2,500. Okay, and my ending retained earnings is beginning retained earnings plus net income or minus the net loss if you have a net loss, minus the dividends equals ending retained earnings, 64, so this is what, 61,500, ending retained earnings on December 31st, which we know goes onto the balance sheet and the stockholders' equity statement. Bear in mind, we've already prepared our financial statements. Now what we're doing is we're simply preparing the books, the records, the ledger for the next time period. We've closed out the temporary accounts, revenues, expense, and dividends. They all now have zero balances, and we're ready to roll for the next time period. And we just do this period after period. That is the closing process.